the insurance industry. You hand over your hard-earned cash, those monthly premiums, with the understanding that when disaster strikes, bam, your friendly neighborhood insurance company will be there to swoop in and make things right. But sometimes that trust, it gets violated. We're talking full-blown, honey. Where did our life savings go? Levels of betrayal. Throughout history, the insurance game has seen its fair share of scandals. From schemes that would make Bernie Madoff blush to companies treating legitimate claims like they're written in disappearing ink. So, buckle up, dear viewers, as we unpack 5 of the biggest insurance scandals to grace or disgrace this planet. Our first stop on this delightful tour of corporate malfeasance takes us across the pond to the UK. Picture this, the year 2000. The dawn of a new millennium, the Y2K bug was a bust, and the world was feeling cautiously optimistic. Except, that is, for the policyholders of Equitable Life, one of the oldest and seemingly most reliable insurance giants in the world. They were about to get a very rude awakening. Equitable Life had made some, shall we say, creative promises to its policyholders. Promises involving guaranteed annuity rates which, and this is the important bit, they couldn't actually guarantee. Now, for a while they managed to keep this whole charade going. But then, like a house of cards built on a shaky foundation of actuarial malpractice, it all came crashing down. The result? Over 1 million people, many of them retirees who had entrusted their golden years to Equitable Life, saw their pensions vanish faster than a politician's promise during an election year. The collapse of Equitable Life sent shockwaves through the UK and beyond, prompting investigations, lawsuits, and a whole lot of soul-searching within the insurance industry. It was a stark reminder that when it comes to your financial well-being, trust should never be a blind leap of faith. Let's rewind to 2005, shall we? Hurricane Katrina, a storm of truly epic proportions, slams into the Gulf Coast of the United States. New Orleans, a city known for its vibrant culture, jazz music, and unfortunately, its precarious location below sea level, is utterly devastated. Homes are reduced to rubble, lives are lost, and the human cost is immeasurable. Now, you'd think that in the aftermath of such a disaster, insurance companies would be stepping up, checkbooks in hand, ready to help people rebuild their lives. You'd think that, wouldn't you? Well, my friends, you'd be wrong. Instead, what unfolded was a shameful display of corporate greed and negligence that added insult to very real injury. Thousands of homeowners, many of whom had dutifully paid their insurance premiums for years, suddenly found themselves trapped in a bureaucratic nightmare. Claims were denied, delayed, or paid out in paltry sums that wouldn't even cover the cost of a decent meal, let alone rebuilding a home. Insurance companies, it turned out, were hiding behind the fine print of their policies, arguing that damage caused by flooding wasn't covered. The Hurricane Katrina insurance scandal exposed the ugly underbelly of an industry that too often prioritizes profit over people. Fast forward to 2008. The world financial system is teetering on the brink of collapse. Banks are failing, credit markets have frozen over, and everyone is running around like a bunch of headless chickens. And at the epicenter of this global economic meltdown, none other than AIG, one of the biggest insurance companies on the planet. AIG had been dabbling in something called credit default swaps, which are basically insurance policies on other financial products. Sounds boring, right? Well, it would have been, except for the tiny detail that AIG had insured trillions of dollars worth of these things, many of which were backed by, wait for it, subprime mortgages. When the housing bubble burst, those subprime mortgages went belly up, triggering a chain reaction that threatened to bring down the entire global financial system. AIG, which had insured all those toxic assets, suddenly found itself on the hook for billions, no, trillions of dollars. The US government, fearing the worst, stepped in with a massive bailout, effectively nationalizing AIG to prevent a complete financial apocalypse. It was the largest government bailout of a private company in US history, and it left taxpayers fuming. The AIG debacle wasn't just about one company's reckless gambling, it was a symptom of a much larger problem: the unchecked greed and systemic risk that had infected the entire financial system. Let's talk about Wells Fargo, shall we? Now, you might know them as that bank that's been caught in more scandals than I've had cups of tea this week, and believe me, that's a lot. But this particular story, this one involves them venturing into the wonderful world of insurance, and let's just say, it wouldn't be a Wells Fargo story without a healthy dose of shall we call it creative business practices. Picture this. You're a Wells Fargo customer, just a regular Joe trying to navigate the murky waters of personal finance. You think you're being responsible, maybe even a little bit smug because you have car insurance. You're covered. Except, are you? In 2017, news broke that Wells Fargo had been signing people up for car insurance without their knowledge or consent. That's right, folks, they were out here playing insurance fairy godmother, except instead of glass slippers and handsome princes, they were handing out unwanted policies and hefty fees. Over 800,000 customers were affected by this delightful little scheme. People who didn't need car insurance were being charged for it, and in some cases, these phantom premiums were causing people to default on their actual car loans, leading to their cars being repossessed. Wells Fargo, in their infinite wisdom, blamed it all on a glitch. The fallout was, as you can imagine, spectacular. This wasn't just a case of corporate greed, it was a betrayal of trust on a massive scale. For our final stop on this whirlwind tour of insurance scandals, we're heading east, to the bustling, vibrant nation of India. And the culprit this time? None other than LIC, the Life Insurance Corporation of India, a name synonymous with, well, life insurance in India. They're kind of a big deal. Now, LIC has long enjoyed a reputation for being a reliable, trustworthy institution, but in 2019 that image was tarnished when a bribery scandal erupted, shaking the Indian insurance industry to its core. It all started with whispers, rumors of shady dealings and backroom agreements. Then, the whispers grew louder, the rumors more insistent, until finally, the truth exploded into the open. It turned out that high-ranking officials within LIC had been accepting bribes in exchange for awarding lucrative contracts to favored companies. This was bribery on a grand scale, involving millions of dollars, shell companies, and enough intrigue to make a Bollywood screenwriter blush. The LIC bribery case sent shockwaves through India, sparking outrage among the public and prompting calls for greater transparency and accountability within the insurance industry. Well, there you have it, folks. 5 tales of insurance gone wrong, each one a stark reminder that in the world of finance, trust should never be given blindly. Whether it's a venerable institution collapsing under the weight of its own hubris, or a global financial giant gambling away our future, these scandals show that when it comes to insurance, it's not just about protecting yourself from risk. It's also about protecting yourself from the companies you're paying to do the protecting. But don't despair. While these stories might make you want to stash your cash under the mattress and call it a day, there are ways to navigate the insurance landscape without getting fleeced. It all comes down to doing your homework, asking the right questions, and most importantly, reading the fine print. Want to delve deeper into the murky world of insurance? Be sure to hit that subscribe button and join me next time when we'll be exploring why insurance rates are about to skyrocket in 2025. Until then, stay informed, stay vigilant, and for goodness sake, read your policy documents.